Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Margie Click, the CEO of AgFed Credit Union. This was a really interesting conversation. We started with some of Margie's history in the industry, the 4 C's of credit, as she was taught them when she first started in the business, how that's kind of evolved, both in terms of how we think about creditworthiness of people and evaluating credit applications, but also, I think, importantly, the kinds of products consumers are looking for and how they're looking for them. She also talks about kind of the fintech partnerships, why they're important for institutions like hers, how to find the right partner, what to be looking for the right fintech partner that can help you meet your objectives. And we really did delve into a little bit of AI and how these kind of enhanced capabilities are really almost inevitable, I think, in the way she describes them because of their impact on the business, but also can be beneficial to consumers and to institutions. And I think that's a really interesting note. So it's a really fascinating conversation looking at the history of the banking industry writ large over a pretty good period of time. And I think everyone has a little something to learn from Margie's experience. So please enjoy this conversation with Margie Click, the CEO of AgFed Credit Union. Margie, welcome to the podcast, and thanks so much for taking the time to join us.
Well, dear, thank you for asking me.
Yeah, I'm looking forward to the conversation. Before we dive into some of the specific topics, I wanted to ask, how did you get into the credit union space, the banking space? Like, I don't think most of us grow up thinking I'm going to be a banking executive when I grow up. So what was your journey to this place? How did you kind of end up here?
Well, I ended up I'm one of those very old tenure stories. I started as a teller many years ago. So at that time in a savings and loan. So I come from the banking industry.
Started as a teller in a savings and loan. That's like,
yeah.
You've seen the whole spectrum of the business then.
Yeah, trust me, a lot of history. And I was always on the, coincidentally, always on the automation part, operation side. And I ended up working for Fiserv for a number of years. I was a conversion analyst and studied systems and everything. And then a savings and loan basically hired me and moved me out here until they went under. That's when all the savings and loans went under. And I worked for a regulatory agency for a short bit, and then I came here to this credit union. It's the first and only credit union I've been with, because it reminded me at the time, God, it was in the early 90s, of the old savings and loans before they got deregulated. So it was exciting to see the development and the growth. We were only about 60 million then. Now we're close to 400.
Wow, that's a lot of growth.
Yeah, it is, but it's been fun, and it's more been organic growth, than it
That's
goes.
great.
So I've loved what I do.
Well, you were telling me from your background the old 4 C's of lending, and I know the 4 P's of marketing, but I guess I'm so new to the lending industry, I don't know the 4 C's of lending, which kind of the historical way we looked at evaluating credit. Tell me a little bit about the 4 C's of lending.
The 4 C's of lending, and that's what you used to learn in banking school, was as far as credit, collateral, character, which is now known as capital, which is cash, and capacity.
Capacity.
Yeah, capacity. I mean, how much you make. Character is.
So this was the criteria upon which you evaluated loan applications, the 4 C's.
Correct. And you used a credit report, and you just scanned through it. And then back in the 90s, they introduced risk-based pricing and credit scoring. So that's in a manual, or in a sense, that's when they started pricing to the credit scoring. The old, I'm not sure if you ever heard of Rex Johnson in the lending industry, consumer lending. So he introduced that here and mentioned many of his lending schools. So,
yeah. Interesting. It's fascinating to think about lending in a day before the credit score was the way we primarily thought about creditworthiness, back when you had to do it a little more by hand.
And in those days, they would look at the person face to face, and it was depending. I mean, I don't want to date myself, but if you were married and didn't have a job, you wouldn't get a loan. God forbid you wouldn't get a credit card. So there was a lot of different criteria of that was done that was not part of your character. But anyway.
Probably varied quite a bit from loan officer to loan officer in terms of how they applied the 4 C's, and probably not as consistent and uniform as we would hope for lending outcomes to be.
No, absolutely. I know for a fact it was not.
Yeah, it's fascinating to think back to such days.
Mm-hmm.
How have you seen that change? I mean, obviously, it's a different approach. How do you think about the shifts in how we're evaluating creditworthiness, moving to credit scores and other ways of looking at assessing creditworthiness?
Oh, I actually think that in some respects it's improving. It's not only more efficient, but I think in a sense it can be considered much more fair. Just sitting down, and when they added the credit scores to the credit bureaus and you were pricing it, was much easier to explain to an individual, that show them the report and show them this is why. And just like a auto insurance, if you got into an accident, you made a mistake, you got to pay for it, but you can, build yourself back up and rebuild it and, reprice back down. So again, that was still manual, but that was with the credit score. So I feel as if it actually removes some of the subjectivity that I don't think, it removes the fact that, okay, this person isn't dressed properly, but could be a millionaire. I mean, for lack of a better thing.
It's a simple example, yeah.
Yeah, very simple. I think it makes it much quicker. It prices it better, and I think in some respects, at least what I've seen thus far, there's individuals that are getting better priced loans that they would have been if they would have come in-house in the traditional sense, or they would have been denied, and yet they get the loan elsewhere.
Yeah, that's the thing I always try and keep in mind when I think about specifically AI, but any kind of advanced analytics. When you think about credit underwriting, is so many more people are good credit risks than look that way. I mean, you look at a subprime pool of loans, and the vast majority of those people actually will repay loans, will not default. And so there's lots of good borrowers. And so whenever you can make a model that's more accurate, it may feel like a business reason, like it's I get more yield or whatever. But like really, a more accurate model will approve more people and lower the rates for an average consumer, because most people are creditworthy, and it's better able to identify them, and that's ultimately good for consumers, right? If we can go into a world where we're approving more people and lowering the cost of borrowing, that feels like ultimately what we really should be striving for as an industry.
I agree, and as well as what's the good part about it as well is that it also brings the reward. I mean, the credit union industry is about helping people, but I think the more people you're able to help, and the more loans you get to do, you also make enough money that you can support to sustain whatever individuals were unable to. And it goes back in the whole Capital One, when they first introduced the massive credit cards, and everyone thought they were nuts. Now look at them.
Yeah. Yeah. No, it's so true. If you can make the business more sustainable, you can reinvest those profits into into the other programs. So talk to me a little bit about fintech partnerships. I mean, I know you guys have kind of walked down that path, and you're, I think by your own description, a bit of a conservative approach to a lot of the banking space, and fintech is maybe not a conservative way to go. So I'm curious how you think about finding the right partners, the right areas for partnership, and evaluating where you want to make that kind of partnership versus, staying away from a space or building something in-house.
Well, I think that for the past 12 to 18 months, COVID changed, which you see in every article everywhere. COVID changed everybody's life and changed the approach to everything. And you no longer could sit there and be, paralysis by analysis, sit there and wait for things to happen. You didn't have a choice. You had to make some quick decisions. And there was a point, and it was a point in the past year that I said, either you're going to fight the change or you're going to embrace it and run with it. And we made the decision to embrace it. And then we started looking at different fintechs or companies that call themselves fintechs that really aren't, or companies that don't call themselves fintechs, but they are.
They really are.
Yeah. And trying to find out what made us feel comfortable. I mean, we go through, as I mentioned earlier, we're known as being very conservative, very, very conservative. And you practically have to be stellar to get an unsecured loan with us. If anything, we've gotten criticized as our denial rate of unsecured loans. And so anyway, going through and doing the due diligence and finding out the relationships and the analysis that the fintech has gone through and the detailed process and procedures, what they go through for themselves, and not necessarily just to make the deal. We had ones will just make the deal. You know, the more questions you ask, the more they didn't want you. Was basically what it was. And we ask a lot of questions. And I can remember one company basically telling us that we're just too much. We're just too much. They didn't want a deal. And then when I was dealing with, and it's Carl at Upstart, and he was selective, and he was interviewing us as we were interviewing, making sure it was a good partnership. And I guess when I do my interview for hiring people, that's how I like to do it, is make sure it's a good partnership. It's not just that I like you, but that you like how we do things and operate, so that way you can be a huge success. And that's what, I guess, set Upstart against the other entities, which I won't name the names. And actually, I look at it as a vendor relationship as well. I mean, because you're trusting these vendors and they're representing you. And I had my whole executive team going through the process, and we thought, because pricing is always, you know, you always are trying to get more for the buck. We all are here to make money. And and there was no push, it was no hard. So we thought to ourselves, we couldn't do what they do. We couldn't. We would fail. We would fall on our face. And we quickly made that decision. And every step of the way, how impressed, and my VP of Risk and Compliance, we went through everything. And I have never seen a company as well organized and top-notch. And I mean that very sincerely. I talk to marketing, I mean that, in everything that they do. And I'm afraid to say that because I'm afraid something will go wrong. But anyway.
Well, you can call us back and let us know, but I'm confident. But I love the point you're making, which is really interesting in the evaluation, which is not just like, can someone answer the question? Will they, right, engage in that? But also, I think there's a degree of what you're describing is like, does it feel like they're figuring it out when you ask and getting an answer, or does it feel like something they've thought about and have actually, you know, put some effort into preparing? Because that's a very different thing. Someone goes, oh, that's a really good question about how we comply with that regulation. Let me go ask somebody what we think, versus saying, here's a documentation on how we think about that and what we do. And that's a level of preparation that's different.
Oh, I have never seen it with any vendor, actually. I mean, they've probably gotten better because of the regulatory people, but no, it's all right there. You guys, you know how you strive for an employee to know the answer to the question before you ask the question. That's what my VP of IT always tells me, that he wants to know the question before I ask him. That's his goal. And that's you guys really, you did that.
Okay, well, that's been our objective for a while, to know what's going to get asked, to be ready for it.
Yeah, but that says a lot, and I don't think you can't take that for granted, because there's very few people that I've come across that have done that. Very few companies, I should say.
Well, there's some advice for any fintech listeners. Know the questions you're going to get asked and be ready for them before you're asked. That's, I think.
Oh yeah. Well, actually, there's some other partnerships we have, because that are interested in what we're doing with you guys, because they're like, because they know we're the Doubting Thomases of the world. And they are, which I guess, and I'm jumping all over the place, so you can pull me back, but
That's okay.
The regulatory agencies, and I'm thinking to myself, they should be jumping all over. There's some other relationships that are very similar to the, you're more of a sophisticated AI, where there's other ones that are not quite as sophisticated, but it's the same thing. So, anyway.
Well, I want to kind of explore. I mean, you guys got into personal loans with us, and we're working together there. But I know you started off in some like home improvement space, kind of like thinking your way into the unsecured space. Would love to understand your thinking behind that and why you think there is. I think in the old school 4Cs days, unsecured loans were not a thing that was looked kindly upon as a reasonable risk for institutions to take. Why do you think that's shifting, and how did you guys think about changing the mindset, but getting into a category of lending that wasn't really in the old days considered good, or at least not good to have at a very large scale within the institution?
Well, what we did was, and that's very true, it was not a good thing if you needed an unsecured loan and a debt consolidation loan. Well, through a partnership with another CUSO, we began to do some home improvement loans. And they're insured by a insurance company, whatever, and they were large loans. Well, our experience was the losses, they were insured, so we really didn't incur any losses, maybe one. And if you go back into just a few years ago, home equity loans that people used to get the large loans for, whether it was for a wedding or home improvement or whatever the case was.
Sure.
People used to get tax write-off. And that's why they went that way, and they went through the process, which generally takes appraisals, and there's a lien placed on your house, and it takes a long period of time to underwrite it. A lot of paperwork, just like a mortgage. And then they took that benefit away, or you have to prove the benefit more. So I think as time progressed, and as people became more and more impatient in waiting things, it's much easier to ask for a personal loan and to pay it back, and there's no difference. And they're priced close to the same.
Yeah, there's a little difference, but I certainly see now that consumers are kind of going, if it's going to take 60 days, and I know appraisals right now are a real pain point in the industry because appraisers are kind of in short supply. So it's a real timeline. Like, if it's an extra $10 a month and I can get it tomorrow as opposed to a month and a half from now, like most consumers value that time pretty highly right now.
Oh, absolutely they do. And the with interest rates going up and stuff, that's where the pricing is getting close. But they, no, I agree with you. And people don't have the patience to wait. They want it done within 48 hours, and they don't like to be asked a lot of questions.
Yeah.
Whereas you have your underwriting, which most of those questions that you get asked are done in an automated fashion. They don't have to bother with that. They don't care.
Yeah, and they're happy to give you a little bit of information to make that easier.
We
were talking about, though, also how there is still a need for, while we're aiming for frictionless and instantaneous approvals, it's kind of not a reasonable goal to get to 100% zero touch lending is probably not the goal. Tell me a little bit about your thinking on that, because it feels like, I guess, from a pure technologist point of view, you go, that's right, no people anymore. We get rid of them all in all cases, but that's probably not ultimately the answer.
No, but the one thing, and again, this is another thing that impressed us with the organization, with Upstart, was that you still need some human interaction at some point. There's some cases, and there's some that, because of your fraudsters and always trying to play with the systems or whatever the case may be, or individuals asking questions, you may need some human interaction. So I don't think people will go away totally, but I think it's more the exception. And I think sometimes a periodic manual review also helps the people in the technology area to see what's covered and what isn't covered, or what they may see or not see. Although I do think that you're going to be able to get a loan through your mobile phone with the fingerprint, without question.
Well, particularly this is where I think financial institutions that have customer relationships have such an advantage, because if I've never seen you before, it's very hard to take your fingerprint and give you a loan. But if I've worked with you for a while, you've got your bank deposit, your direct deposit coming into my account, you've had a loan, like all of a sudden it becomes really easy to go, yeah, I mean, come in the app, give me your fingerprint. Like, I feel pretty good about my ability to understand your risk. And that's really a place where financial institutions that build over time relationships that are recurring with the customer really have an advantage to simplify and automate those processes in a way that, if you're walking into a bank or credit union for the first time, that's really hard to do. We got to get comfortable that we know something about you. And that's not as easy for the first time.
No, it's not.
Yeah, it's interesting too to watch the evolution of fraud and do you guys have concerns that you're worried about as fraudsters are becoming, I think, more targeted and persistent, if you will, in their attempts? Is they're kind of like an arms race. They're ratcheting up their level of sophistication in attacks on institutions. At the same time, we're ratcheting up our capabilities to fend off or identify such attacks.
No, and I agree. And as well as, again, that's part of the manual intervention. I think that we have found some things, and I know that you guys had said that early on in the early launch, there used to be called what they call loan stacking. And after a period of time, you guys identified that, so you had to plug it. So who knows what it will be the next time? Whether it's with you or even with the individuals. We just got recently hit, so did Navy and Pentagon, with people just with these stolen identities we have all the information, more than they ever did before, that the systems weren't catching. So we had to quickly, in the 2 weeks, had to add another piece to stop it.
Yeah,
so,
we've had the same thing where we see people with all the right information, even bank accounts opened in the name, and they're finding specific, if I ask for a smaller loan and I have this kind of, these kind of things, I'm more likely to get through an automated. And to your point, I think it's really important to have a very tight integration. One of the reasons we haven't done a lot of outsourcing of staff on our operations side is like being able to learn quickly on the product and automation side what we're seeing in the manual review side and have that be a give and take is really valuable, because you might see this where you identify one and you go, I wonder if there are others like that. How can we find it? And it really is it's a very tight feedback loop to effectively find and stop those kinds of attacks.
Oh, yeah, definitely. We were just recently, that nothing to do with Upstart, it was a group of us getting together and trying to find what the people were doing, but it took all of us, and then we found a whole huge group. You had to shut down the systems. That jokingly, I said, well, that's where the manual intervention helps,
Yeah, it's the number of times we found, some fraud attack from a human on our side who was reviewing something and said, this is weird, and then called another person and we started reviewing data and saying, hey, like, who else looks like this? What are the signals we might be able to find to see if there's other attempts at this kind of thing? It's a really valuable thing. It'll be a long time, because your adversary is changing their tactics. It's not easy to identify that in an automated way when they're coming with different approaches every time.
Absolutely.
Yeah. So I think I've asked most of the questions I had on my list. Was there anything else that was on your list that you expected or wanted to talk about while we had you here?
No, I'm just anxious to see. You can say, what do you think the next trend is going to be?
What do I think the next trend is going to be? Oh, that's a tough one.
You're on the other side.
Now you're flipping the microphone around on me.
Yeah. You're a different generation than I am.
Well, I just had a guest who was telling me about TikTok and how his daughter's learning about financial products from TikTok. And I said, I'm not even on TikTok, so I'm behind the trends now.
No, that's true.
But I still think that the fingerprint example is right, that the trend is going to be towards utilization of AI or better automation technologies to reduce friction for as many customers as possible. And my real belief is that those institutions that are able to leverage their data and relationships to be ahead of that curve are going to win. And those that aren't, I hear these kind of concerns around open banking, and I think it's interesting. People worried about, well, now my transaction data can be visible to some other bank, and like that puts me at risk. And I go, well, like how would you rate from 0 to 100 your utilization of that data today to get better credit decisions and better experiences to your customer? Like a 20. I go, well, why don't you work on going from 20 to 100, and you'll have some stability. Take advantage of that data. Those who can make that data into a really strategic asset and leverage it that way, I think are going to have a lot of opportunity. And I think but I think that kind of frictionless experience is coming, and you got to find ways either build or partner to deliver.
Yeah, I think it's happening quicker than I thought it would.
Yeah,
I think COVID helped, but
technology change, in my experience, happens very slowly than all at once. It kind of feels forever away, and then and it's here, and all of a sudden it's happening yesterday. So I think we might be at one of those inflection points where it's going from we know it should be possible to, oh my God, it's actually happening really rapidly, and the next 5 or 10 years will be a time of rapid change. Awesome. Well, Margie, I have 3 questions I ask everybody at the end of this podcast, so I'm going to throw them at you now, and we'll see what you got. The first one is, what's the best piece of career advice you've ever gotten?
it goes way back. When I first started out and someone told me, don't always go for what your passion is rather than go for the title or the money. And try to do the best at whatever that is, and the rest will come. And it did for me. Anyway. So and always be honest and keep integrity.
Always be honest, keep integrity. I love you. You're almost quoting Abe Lincoln here. Whatever you choose to be a good one.
Yeah.
I try and tell that to my kids all the time.
I'm a very simple, practical person.
We just got to get that one through my kids. It's I don't really care what you want to be, but whatever it's going to be, work hard at being good at it.
Yeah,
right?
exactly. And then they'll succeed, whatever it is.
Yeah. Well, my kids are still young, so I got to just a little more drilling into them.
My daughter's 23, so that's what I tell her.
That's right. Good advice. Second question, what's the best piece of advice you've gotten about consumer lending or consumer banking in your career? You've had a number of different institutions from which to take advice, it sounds like.
God, probably the best advice is really more of the recent advice, as far as the way the picture was drawn back in the old days. Wasn't necessarily the fair or the right way to approach it, and I think there was a lot of opportunities that were missed along the way through consumer lending in general. Not just saying with our credit union, just in general. And I think I say this sincerely, is I think that and I'm anxious to see the results, because if they're anything like the first few weeks have been, we would have given a lot more loans into a lot more people than we would have had in our traditional methods. And I'm proud of that. And
That's
I'm
great.
glad for that. Yeah.
That's what gets us out of bed every morning, is making sure we're providing a product that helps people say yes to more people.
Yeah, no, and that's what you're doing what I love.
All right, so the old way is not always the best way. I think it's sometimes as change comes rapidly, there can be a nostalgia for the old in a way that forgets that hey, that wasn't perfect either.
I mean, no, and I know, and I'm old-fashioned, so I guess I find this more exhilarating. So, and I just think it's better. It's better for everybody, for the consumer as well as the financial institution.
And my last question for you, what is one bold prediction about the future? Can be banking, doesn't have to be.
Oh, about the future?
Yeah. Well, see, it's easy to make predictions about the past. We gotta make something a little more challenging.
Yeah, I know. I don't know if this is a prediction or a fear. I get it. You get into all the change of currency and the cryptocurrency and what's going to happen with all of that. I guess I learned, I'm old enough to know never say never for anything. But I just am afraid that the financial industry is just not what I know it to be. And I guess it maybe doesn't need to be, but it'll be on my lifetime. So I think it's totally changed.
It is totally changing. I'll tell you, to your point, the old ways aren't always the best. I watched some of the crypto stuff, and I'm very fascinated. I think there's a lot of interesting stuff going on there. But you do see a very rapid learning of the old lessons in many cases. You saw this, bug on OpenSea, where arguably a bug or not, but where a bunch of NFTs were sold for well below what they were worth, and people are like, well, if it were my bank, I would call them, and we'd have a way to fix this.
Yeah.
Oh.
Yeah.
Hey, we might need a way to have a resolution of a dispute like this, and the blockchain there really isn't. And so I think there's very great innovations there, but it'll be also interesting to see how I think sometimes the new ways forget some of the lessons of the past that have very important things to teach us. So
I think we all need to learn lessons of the past. That's what history teaches you.
That's right. Well, Margie, I appreciate your time today. This was a lot of fun, and I appreciate your sharing your insights with our audience.
Well, thank you. I appreciate it, Jeff, and good luck to everybody.
You too.